presentation of Financial Crisis Recovery.
Foreclosure, short sales, bankruptcy, credit card debt, job loss, depreciating home values, money management. Peace of mind when it comes to your finances seems completely out of reach under current conditions, but there is a way to achieve it. For the next 60 minutes, you're going to find out how to cover your assets. Cover your assets. Now, here's nationally renowned speaker and expert on getting you on the path to financial strength, Todd Rooker.
Good morning, and welcome to Cover Your Assets. Today's topic of our show is the best offense is a good defense. So how to protect your assets. First, I'd like to start today's show by sharing some invaluable information with you. To succeed financially, you must begin to develop a financial vocabulary. So listen carefully to today's terms that are being used and what they mean. This is going to enable you to have a more meaningful dialogue with a financial professional, which undoubtedly you'll have to employ the services of as you go along. I get clients all the time who are looking for help, and they're doing the best that they can to try to make the changes that they think are prudent and will be helpful, but never learn the basics at the onset of their business startup. And as a result, if they would have, they'd be in a much stronger position. They can't talk to people. Consequently, the professionals can't bring them along in the conversation fast enough. And my guest today is Tom Fafinski with Virtus Law. Tom Fafinski is what I would consider to be, and I teach classes all over the United States. I teach classes to attorneys, CPAs, financial advisors. And so I know who's great and I know who's good. And as I always like to say, I don't get my references from the bulletin board on at the coffee shop. Tom is phenomenal. Tom, good morning. I'd like to just have you tell us a little bit about yourself and your practice.
Good morning, Todd. Thanks for having me today. We have a group of 7 attorneys, and we do work as it relates to 2 things, really. If it involves a privately held business interest or a real estate interest, and it could be that we're representing the investor, it could be that we're representing the business itself, or a lender relating to those interests, but it always relates to those interests. Within the firm, my role, so I spend a lot of time with the whole asset protection, estate planning component. Sometimes designing plans, sometimes trying to attack plans.
Well, and Tom, you and I had a little conversation before we came into the studio here, and we were talking about some of the synergies that we have. Tom and I worked together long before the radio show, and so I have infinite confidence in Tom, but I want to share something that I talked to Tom about. I began my financial planning career about 28 years ago. And when I did, I grew up on a farm in Crookston, Minnesota, and generational tax, wherein as much as 50% of the value of an estate could become due within the death of the final decedent. And so my idea was, after I went to college, got out of the military, went to work for a company called IDS Financial Services way back when, I was going to do estate planning. And so we went up to northern Minnesota to work with the family farmers, the people that I and this other young attorney knew. Found out very quickly that estate planning was the least of their concerns. They were concerned more with, how do I go to war with the people who used to be my best friends, the bankers who are now liquidating my family farm. And the contrast in what I'm talking about is the difference between having done something long in advance before the storm hit, as opposed to trying to fix and preserve things or move things around in time to protect them as the bank and its attorneys are simultaneously pursuing you. And so often, Tom, I would say to myself, God, I wish we could have just gotten to these people a year before or just a few months before. But of course, like most things in life, nobody worries about anything until something goes wrong.
Absolutely.
So today we're going to start talking the show, discussing things that an individual might do in order to protect their assets and eventually move into information related more to small businesses. That being said, I don't want to discourage questions from anyone at any time. So if it's not necessarily on the topic that we're on at the moment, but it is relatable to the overall topic of estate planning and asset protection. And that point that I was making is, a good estate planning attorney like Tom almost will shy away from the term asset protection, but because it presupposes that you're hindering your creditors. You never want to do that. That's problematic. But in all reality, of course, you are protecting assets, but you need to do it long in advance. You can't do it when you've got a judgment on the table. It's a whole different world at that point. I mean, there's things you can still do, and we do that, but it's very different. So if you have a question, even if we've already covered it or even if it's not come in yet, by all means, give us a call this morning at 651-646-8255. Want to say that number again, 651-646-8255. By all means, we welcome your questions. So if you're curious about how to protect your assets, please give us a call and we'll field your questions. So, Tom, when I first approached you about being on the show this week, you knew exactly what you wanted to come in and talk about. Is there a reason that protecting your existing assets and having a good defense was so important for you to talk about while on the show today?
Yeah, you've actually touched upon it. When people engage in deals or transactions, they go to the involved parties like banks and investors, and they show the assets that they have, and they say, when you deal with me, this is what you're going to get in terms of my assets. When the transaction actually transpires, it's uncommon that they have to pledge every asset that they have to secure the obligation that they're undertaking with the bank. Normally, if they're buying like an apartment building, normally it's the apartment building that has to be pledged and not maybe the interest that they own in 3M stock through a mutual fund or some other equity holding. So it is, but the lender looks at those assets and they say, okay, well, if worse comes to worse, I'm going to be able to go to those assets too. Now, the fact is, most banks will do transactions even if there isn't that type of liquidity available if they know about it in advance. They have this absolute right to expect that people are not going to squander their assets away and transfer them for far less than value if they're approving a loan based upon a specific type of asset base. So, what I really wanted to talk about is how important it is that you plan in advance before anything even happens that is bad to make sure that your assets are in line and that you're pledging only the things that you need to pledge when you're doing a bank deal.
So when we're talking about a bank deal, and this is kind of back to that terminology, we're talking about guarantors and security interests. We're talking about an individual who's pledging possibly, God forbid, a personal guarantee on a debt, which means that then you can be pursued for all the other assets that you've got, or more specifically, a piece of property, real estate, an asset, some type of asset that is being pledged as a security interest to collateralize that loan. That's what we're talking about, right?
Absolutely. And that guaranteed debt, normally, it's an entity that's doing the transaction, and the bank says, okay, we want you to guarantee it. And I get clients that come in and say, well, I've got this guarantee but it's not secured or anything. I mean, I haven't done anything. Like, it's not a big deal. Like, oh, hang on a second. This is a big deal. It's we call it a contingent liability. And when you guarantee a debt for, let's say it's a $2 million building, when you guarantee that debt, well, it's a $2 million contingent liability. You don't get credit for the value of the building necessarily when you're trying to quantify that. And from an asset protection standpoint, it's really important that we take into account that contingent liability when we do what I'll later discuss as our solvency analysis. But, to get back to your question, I'm sorry, I don't mean to overcomplicate it. If people just do things on purpose instead of just on accident, they're much better off. If it's worth doing, I say this all the time, if it's worth doing on purpose. You do it on your offense in your business and in your financial, when you're trying to preserve your financial wealth, when you're trying to create financial wealth, you do it on purpose, right?
Absolutely.
I mean, people save money from their paychecks, or they go into these investments with the intention that they would gain wealth. They do it on purpose. But they don't spend any time on defense. And it's not just because we're on ESPN radio that I wanted to talk about a good defense. It really is important to protect what you've...
Well, you have to assume if things go wrong, what can be taken away, what's going to be lost, what's going to be kept. I mean, I've always said asset protection 101, you never commingle credit and finances with a married spouse. And likewise, as you say, the idea that it's not a big deal that you've got all of these other assets pledged because nothing's ever going to go wrong. I mean, you and I get paid to deal with when things do go wrong too, right?
Yeah, absolutely.
And so to go into something assuming that nothing is going to go wrong is really an improper way to do things. So, as you begin to build assets, be conscious of what it is that is being pledged. The other thing that's obvious is that when you're dealing with banks who do portfolio loans, and these are loans that are renewable every 1, 2, 3 years, the bank will start off with security interests in certain assets, and as it goes along, they'll wrap their arms around more and more things, and people will just blindly renew these renewable notes, not looking at the fine print because, maybe they hired an attorney to look at the first document, but as they go, we've now renewed this note 5 times, and they have added infinitely more and more assets as you've walked along, and you didn't even read it as you were signing. I see business owners doing that kind of stuff all the time. Do you as well?
Absolutely. They will submit updated financials and sign whatever the bank asks them to sign. I've actually had situations where the bank has said, if you don't sign this and you leave the building, we're not going to do the deal.
Absolutely.
And that is, I mean, that's the lenders I work with don't do stuff like that, but that has happened.
Well, it absolutely happens. And, another issue that is absolutely something I deal with on an ongoing basis, and those of you who listen to the show, my clients are people who've never missed a payment in their lives, and out of nowhere they're running out of money. They're trying to do the right thing. They don't know how to not do that, but they're just simply delaying the inevitable because they're using whatever resources they have to subsidize their payments. They're in an upside down position, and then the questions become orderly liquidation of the business, foreclosure, short sale, deed in lieu, loan modification, credit counseling, and then this worst horrible thing, bankruptcy. And I see this all the time. I mean, this is my world. And I'll see clients who have multi-million-dollar portfolio loans, 10, 20, $50 million, are making payments that are 30, 40, 50,000 a month, have not missed a single payment, and out of nowhere, the bank will call the note due. They think it's a formality. They're going to renew it. They always have before. And, they've got a $50 million note on real estate that at one point was worth $80 million. And the bank calls the note due and says, we need you to perform on $50 million. And, oh, by the way, we've done a preliminary assessment of the value of that real estate. We perceive it to be in today's market worth no more than $35 million, and we need you to perform.